What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. I'm your host, Alex Savanovich. I am a trader slash investor at Spoonbill Partners LLC. We trade stocks, bonds, derivative products, you name it, and we've probably traded it at some point. So I know a lot of people listen to the episodes, but if you actually go on the YouTube and watch the episodes, because you like to see my silly face. You probably notice I like to talk with my hands a lot, and I'm doing this and put my hands behind my back, not behind my back, behind my head or whatever. So you might notice that I got a little finger injury here. Just note to all the viewers, do not go on your phone mid-set in the gym. Unfortunately, fractured my ring finger. Not fun. It was pretty painful in the moment, but we're doing good now and we're here for the episode, which is what's most important. So, a little bit of minor housekeeping there. Let's get on with the episode. I've got a bunch of really interesting things to talk about today. So, yeah, without further ado, let's dive right in. So, first big topic that I felt like I needed to address a little bit, there's obviously been a lot of chop in the market. Some really sloppy price action, some pretty bad closes. Not every single day was bad. The day of this recording is Thursday. So today was a little bit better. We closed out on highs because there was some positive developments in the Middle East with Iran, and it looks like deals coming to fruition, and all that jibber jabber about the U.S. Striking Iran Thursday night was put to rest. And so there was a little bit of okay price action into the close on Thursday. But prior to Thursday, there was a lot of chop. I think we can attribute that to a couple of different things. The first one that I've spoken about on the short form videos multiple times is this obviously pending SpaceX IPO to come on Friday. So obviously a massive deal. It's going to require a lot of capital. Not even sure if it's going to open flat, open up, or open down. It's really going to come down to how the demand on the day of the deal plays out. But that's sort of deal dynamics, and that'll come on Friday. But nonetheless, to get the deal 4 times oversubscribed, that's a lot of demand. I think I heard somewhere in the neighborhood of there's $250 billion of demand for this deal, which is a massive number and obviously requires some people to sell off some other holdings to make room for the IPO. And so I think part of that is you see this softness in tech because of this pending massive IPO. And there's also, that's not the only IPO that's going to come this week. There was plenty of others this week, some of them that we participated in. There was EROC, there was PBLS, which was a smaller biotech deal. There was FRBT that opened down. There was AADX last week. That was a big one. That was a defense name. So there's been no shortage of deals this week. There's been a lot going on. And obviously you add SpaceX on top of that, it's a lot of supply coming to the marketplace that we're having to make room for all this new stock. And I'm going to talk a little bit later in the episode about what I think is going on in the syndicate market, because there's a little bit of interesting action in syndicate specifically. But as it relates to the market in general, I think number one, you've got this huge avalanche of IPO activity. So a lot of supply coming to the tape that people have to make room for. I think that's one big reason. I think the second big reason is prior to Thursday. If you go back a couple of weeks, you would remember that the Trump administration was constantly putting out these headlines and news that we're getting close to a deal, we're having constructive talks with Iran, things are going well, and the market saw this steady bid based on optimism. It was just this optimistic tape. We're coming to a deal. Things are great. Oil's going to come back down. And then all of a sudden this week, it felt like there was no deal in play. And obviously, Iran and the US started to exchange fire. Nothing super major, but it felt like we were moving backwards instead of forwards. And you saw oil tick up a little bit. And it wasn't obviously until today when this deal came to fruition at the 11th hour that things started to look okay again. And I think it's a little bit. I don't want to be. I don't want to put my tinfoil hat on and be Mr. Conspiracy Theory Hour guy. But I do think it's a tad suspicious that the day before this massive IPO, and Elon Musk was a massive contributor to the Republican Party when Trump was running. I do think it's interesting that to get this bid back in the stock market and to close out on highs on a Thursday right before Elon's about to go public with one of his largest companies, I think is a tad interesting. It raises maybe half an eyebrow for me. Again, I don't run in these circles. People are a lot more powerful than I am. I'm not with the powers that be, but I do think it is interesting that these two events coincided almost exactly. And so the point I'm making of all of this is I think prior to today, there was a lot of renewed geopolitical tension that added a little bit of risk to the tape, and you saw rates start to tick up a little bit based on that fact. Obviously, I've also spoken on the short form podcast and on last week's pod as well. I think rate hike expectations are moving higher across the globe, so that's a little bit of a headwind. Inflation's a little bit of a headwind. And then the one elephant in the room that I haven't discussed yet on last week's episode or any of the short form episodes is this breathless rally in tech that's occurred in the last couple of months. The SMH and the SOXX, and then more specifically, memory names, optical names, anything really to do with data center infrastructure, the picks and shovels names, hyperscaler CAPEX beneficiaries. These stocks have seen monumental runs. And it was only a matter of time that some money needed to come off the table. Some of these moves were in the upper echelons of very, very rare moves that hardly ever occur. And what I mean by that is if you look at a bell curve, a normal distribution, these outcomes, these runs, these are tail outcomes. They occur in the last tail of the bell curve. If you were to look at all the outcomes that could occur in the stock market, these were tail outcomes that were occurring on almost a daily basis. And so I think we were due for a correction in tech. And also, you add in a couple of negative headlines. Like today, OpenAI says we're going to start to lower the price of tokens to try and compete with Anthropic and steal some of their competitors. And obviously, in a capital intensive business that AI is, trying to compete on price is not usually a great combo. So I think that spooked the tape a little bit as well. Claude also released their public version of the Mythos model that was sort of this guardrailed version. We spoke months ago about Mythos being released to some corporate players and how they were testing it and making sure that it was safe for the public, et cetera, et cetera. And so now Anthropic released this, like I said, guardrailed version, and it didn't really, blow the pants off of anybody. It was sort of basically like a standard release kind of. They called it Fable 5 or whatever. And then last week we discussed this, but Google did their equity issuance to raise money. And then Meta shortly after, I think Google did that on Tuesday or Wednesday. It was earlier in the week, midweek. And then Friday of last week, after I recorded the episode already, Meta comes out and says that we're going to have to raise money as well and do an equity issuance. Then Amazon goes and does a debt issuance in Canada to raise money for their data center infrastructure CAPEX. And then on top of all of that, Oracle reports earnings last night. And then I was watching the price action Oracle today where they raised some of their CapEx figures. And so all of these hyperscalers are continuing to cannibalize free cash flow and then having to dilute shareholders by doing these equity issuances. And so you take all of that combined and you put it all together and you see sort of a gloomy outlook for the tape. And then you consider that the hyperscalers, Meta, Google, Amazon, Microsoft, Apple's not really a hyperscaler because they're not spending money on data centers, but they are part of the Magnificent Seven. But these hyperscalers make up a large percentage of the S&P 500, of the NASDAQ. I think they're 30-something% of the market. My number is going to be wrong there. I know it's not exact, but give or take a few percent, I think it's like 30-something%. You take all that into consideration and it starts to weigh on, tech multiples. And you've had this extreme rally, like I've said, crazy Sigma outcomes, and you're sort of due for a pullback, and then you have a couple of negative developments. I think that's all contributing to some of the chop that we've seen in the tape. So if you're sitting there staring at your TFSA, your FHSA, your 401k, or whatever account that you have, wherever you have the account, if you're sitting there staring at it and like, what the heck's going on? Like, I thought these were the companies. Maybe that helps shed a little bit of light on it for you. I just wanted to address what I think is going on and what I'm seeing happen in the tape a little bit, and what's contributing to some of these moves lower in the broader market. So I think a good segue from that point, let's move on to point number 2, where we're going to discuss syndicate a little bit. And so I mentioned it, that was my first point in the last little bit. I was talking about the market. I mentioned the SpaceX and this colossal amount of supply that's coming to the tape. Like I said, SpaceX, Parabellus, E-Rock, there was Forbright, There was AADX. I'm forgetting the name of the company, but AADX last week. There was another one that we participated in that I'm forgetting the ticker of. But these are just ones that I'm remembering off the top of my head because we actually participated in the syndicate. But there were actually other deals that we passed on from other investment banks. There was just a ton of supply last week and this week. And then you factor in the Anthropic and OpenAI are going to come public at some point this year. And so all of that is, fine and dandy. But let's talk about some of the action that I've been seeing in Syndicate. I get these notes, and I speak to a couple people on the street, and I try and get color on how these deals are looking, how many times oversubscribed are they in like a hot sector or whatever. I'll give you one example here. So AADX is in the defense industry, but defense this year has been a really hot sector. Defense and space technology has been a super hot sector. A lot of those stocks have seen crazy run-ups in their price. And so when you see action like that, and then you hear that the book is 20 times oversubscribed like I did, that tends to be a pretty hot IPO. Now, I can't remember exactly where the IPO opened, but the premium was super meager, and then the stock traded down and broke on the first day, or I should say the evening of the first day after the market closed, and then the next day continued to trade down. So that's interesting to me. That was the first one in a string of odd syndicate price action. Then we move on to Parabellus. Parabellus is a biotech company, and typically with these biotech deals, you see these biotech specific funds participate heavily in them, and that's all that they do. So they tend to act a little bit better. That deal opened with a tremendous amount of premium, but instantly traded down as well. It hasn't broken deal price yet, but I want to say opened $13 higher, and then it traded down as low as 25, and the stock priced at $20. So sort of crappy price action there as well. Now let's move on to EROC. EROC is a electricity generation company. That's a super, super hot sector this year. Like, just because of what's been going on with the data centers and the energy constraints, like that company is right in the midst of where you want to be if you want to participate in sort of this data center CAPEX boom. And when I heard that it was supposedly the deal of the week, had it not been for SpaceX coming public this week, and it was multiple times oversubscribed, and they were potentially going to price it at the high end. I was hearing that there was good demand at the high end of the range. They ended up pricing it smack dab in the middle of the range, and the deal opened broken. So I think they priced it at 21.50, and the deal opened at 20.10. That one was the big eye popper for me because I was like, wow, that's a name that's in a sector that's super hot right now. There was some good banking leads. I want to say I think Morgan Stanley was the lead left. Maybe they were one to the right. For that one not to act well and not to open well, something's going on in Syndicate. These deals are just not holding together. And I know I mentioned, on a few episodes ago, Cerberus continues to struggle. I think it broke 200 recently and then sort of found a bid a little bit. But let's remember, Cerberus IPO'd at a price of $185 and then opened at 350 and broke 200. That's a massive downfall in a company that is also supposedly in one of the hottest sectors. They make AI chips. We talked about some of the wafer technology that they have. So like I said, interesting action in Syndicate. It's been notably weak on average. There's been a couple deals that opened up fine and then traded okay. But on average, these deals don't have the juice that they once did. And with SpaceX coming public tomorrow, I'm going to release this episode Friday morning, so we won't get to actually talk about the SpaceX IPO until next week. But I think a lot of this has to do with the magnitude and size of the SpaceX deal and the fact that there is OpenAI and Anthropic in the pipe. There's just a lot of supply coming to the tape. And if you're not like a top tier, top notch deal, and you're not the focus of the week, it's going to be hard for you to perform. And I've said this on many episodes before, the syndicate market is a great tell for the health of the market. And so we've seen some of this choppy tape action this week, and it's interesting that it has coincided with really blah action in the syndicate market. So I think that's just something to pay attention to. Obviously, we've seen in years prior when syndicate was going really good, the tape also tends to be going really good. And now you're starting to see a couple cracks form, and it's a little bit eye-opening for me and definitely raises a couple of eyebrows, and is something, like I said, I would just pay attention to it because it could be the canary in the coal mine for what's to come. Last thing I want to talk about today is this crazy Oracle report. Let's go through some of the numbers. Let's talk about it, and then I think it'll feed really well into sort of this bear thesis that I know you guys know that I have about AI, data center, capex, hyperscalers, blah blah blah. So I don't know if you guys remember, but back in March when Oracle reported, the stock ripped on the report basically because they didn't raise capex. And so the thinking was maybe they start to convert some of this backlog into tangible free cash flow. And that was seen as a very, very positive thing for Oracle, and the stock went bananas on that news. And then they report last night, and despite reporting a top and bottom line beat, the stock traded down. I want to say it was down as much as 12% at some point today. It took a beating for sure. Full year 2027 earnings per share guide was left unchanged. Full year 2027 revenue outlook was reaffirmed. The software business for sure struggled. But none of this really mattered. The tail of the tape today in that name was the CapEx guide. That completely overwhelmed everything. So they overshot their own CapEx guide for full year 2026 at roughly 55 billion when it was supposed to be 50 billion. Remember, they rallied on the quarter in March because they said that our CapEx is going to be lower than what analysts expected at 50 billion. And so they actually went 5 billion over on this quarter. And that spend unfortunately contributed to a negative free cash flow of roughly $27 billion for the fiscal year. Sorry, not 27 billion, negative 23 billion. So the guidance for fiscal year 2027, they're expecting a net cash capex of $70 billion. And including prepaid GPUs, the reported capex number goes to $95 billion. So what we celebrated in March, the spending slowing, it's actually not slowing, it's accelerating. And I think accelerating more than anything anyone had ever imagined. And then to finance all of this, Oracle flat out told investors on the conference call that they're going to have to raise $40 billion through debt issuance, through equity issuance. So they're going to do one of those dilutive rounds, similar to what Meta said they were going to do last Friday, and similar to what Google just did. And I think that one of the funniest parts of this whole thing is they tried to soften the blow of all this by saying, we have gotten some of our customers to prepay some of the GPUs and the hardware. And I think the translation of that is they're so capital starved that they're having customers front the cost for the hardware because they don't want to be the ones on the hook for it, and making their cash outlay so much bigger. And so I think this paints a picture of a broader pattern that we're starting to see. These hyperscalers, AI companies will announce like this crazy, shiny AI deal, and then they'll quietly after tap the markets because they need some funds badly. You saw Google do it. You saw Meta mention it. You saw Amazon do it in Canada with the bond issuance. SMCI, Supermicro did it this week, and now Oracle's going to have to raise 40 billion bucks out of nowhere. And so it's clear, the AI revenues are not funding all of this capex. What's funding this capex is tacking on debt and diluting your shareholders, which is a nasty combo. And on some levels, you have to respect these companies for doing these equity issuances, these dilutive rounds. I think the froth that we've seen in the equity market, seeing where valuations have gone, these companies see that their stocks are cash rich, and so why wouldn't they sell stock to raise money? So a couple points here that I think just tie together this whole thing. The AI trade is being funded by balance sheet destruction, not revenues, not free cash flow, not anything durable. We've seen this week that even the strongest, biggest players in this tape are not self-sustaining, i.e. Google, Amazon, Meta, Supermicro. Some would argue Supermicro is not a super strong player in this space, but the former three are. And I think Oracle forcing customers to prepay for GPUs and hardware, that's a company operating from a position of weakness, I would say. They're stretching every lever that they have to reduce their capital needs. And what happens when the financing finally outruns this enthusiasm that we've seen in the tape? All this dilution that's occurred is going to really harm investors who've participated in some of these issuances. I guess what I'm trying to say is if the traffic light wasn't already yellow, it definitely is now. And if it's not yellow, it's definitely red. There's no way that this is a green traffic light to keep on spending, keep on doing your thing. I mean, the way that Oracle traded today should tell you everything you need to know about this quarter and make you afraid to own these stocks at these levels. I am not giving investment advice. I'm just telling you what I read every day and telling you what I see. I watch these stocks for 8 hours a day. And so I feel like I have a decent grasp on what's going on. And I don't like to see some of the biggest, strongest balance sheets and companies in the entire tape dilute shareholders and add on debt like it's nothing. That's scary to me, not to mention burning as much free cash flow as they have. So that wraps up another doomer and gloomer episode from yours truly. I've got nothing else to say on any of these topics. I just thought, there was a lot of interesting things in the AI space this week. I think all three of our topics touched in some way, shape, or form on AI, but that doesn't matter. That's all anyone's talking about right now. And everyone's cheering it on and being super enthusiastic. And I'm proud to be someone who's, going to call it black and white and say it how it is, call it as I see it. So that concludes the episode. Make sure to follow us on YouTube, TikTok, and Instagram. I post short form content on there all the time. I'm going to post this episode on Friday morning. I hope you have a fantastic Friday and an even better weekend. Take care, and I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.